Hey, what's going on, guys? Sterling the Investor here. Welcome back to the channel. And in today's video, we're going to talk about a stock that I recently added to my portfolio. It's called Upwork, ticker symbol UPWK. It's an American freelance platform, where individuals and businesses can connect and collaborate and do business together. Major player in the gig economy space, the biggest competitor to Fiverr. Most of you, well, some of you have probably used Fiverr or at least heard of it. May not have heard of Upwork, but you will here soon, and we'll talk about that here in a little bit. It's a stock, like I say, that I've recently added to my portfolio and that I hold. And during the pandemic, this stock has really seen some growth. The pandemic has had a very positive effect on this stock, unlike a lot of companies and unlike the economy in general. This stock has benefited from the pandemic, and here's why. A lot of businesses in corporate America and businesses around the world have found use for this platform for things like payroll, copywriting, admin work, customer support, customer service, even legal work. And the reason for that is because with the pandemic, they haven't been able to have it all in house and they've needed to outsource it. And they've looked to platforms like Upwork and other freelance type platforms. So let's jump into some of the numbers and see if this is really a good company to be seriously looking at. So right now, the company does not pay a dividend. It's currently, still pretty new. So that's not really a huge deal. Market cap around $2.4 billion, which is still very small. So it's a lot of growth there. It's very small compared to Fiverr, its biggest competitor. On the good side, revenue is up 50% from 2017, so we've seen some good growth there. The company is not profitable yet, and I believe that reason is because they're more focused on growth, kind of taking the Amazon approach, not really concerned with short term profit, but more concerned with just growth over time. And as long as the top line revenue keeps coming in, like I say, up 50% from 2017, I think this company will just be fine. And profitability is not really a major concern at this point. I actually see, top line revenue getting to about 415 to $425 million in 2021. Most analysts are thinking more like 400, 390, but I think they'll beat those numbers. And we'll talk about why right now. We'll go into my bullish thesis on this stock. So the reason I'm so bullish on this stock is because big companies and even small companies are considering this as a long-term model because it started out as a necessity, but as they work with it, I think companies are finding more benefit from it, and the biggest reason is the effect that it has on the P&L. So let's say you have a company that has 1,000 employees. You need real estate that can give 1,000 employees office space to work. But if you cut that down to 300, 400, you cut the amount of real estate that you need down by 30 to 40%, which a lot of times, the rent or mortgage for a company is one of the biggest expenses on the profit and loss statement. So if you can cut that down by 30 to 40%, that's absolutely huge. The next thing is, less liability from employees. You don't need health insurance, life insurance, 401k, all of these other benefits that you would provide for a traditional W-2 employee. You don't have to provide to freelancers and, contractors. So you can also cut that down by 30 to 40%, which will have a positive effect on your P&L as well. So with the pandemic not going anywhere anytime soon, in my opinion, I think this company will actually be profitable in 2021. Again, most is contrary to what most analysts are thinking. Most analysts don't see profitability for another couple to few years, but I think with the pandemic not going anywhere, big companies, moving more to this model, small companies taking more advantage of this type of business model, the gig economy just growing as a whole, I think this company will be profitable in 2021, but we'll see. So I ultimately see the stock getting to around 45 to $55, maybe even 60. So we're looking at potential for a 2x to a 3x. I think that's very realistic. So with that said, I'll continue to buy the stock. I'll buy the stock until it gets around the 20 $25 range. And at that point, I'll probably look at some other places to, deploy my cash. But for now, I'll continue to build this position and I'll hold it till it at least gets to $45. So I'm looking at, at least a 2x from where I'm at right now. I started buying around, I think it was like $17 per share. So it'll be over 2x if I hold, to around the $45 range. I'll probably take some profit at that point and then hold the rest, and look to get to maybe the 55 $50 range, and then maybe cash out the position at that point. So with that said, like I say, I'll continue to buy into this position. And as always, if you guys have any questions, leave them in the comments below. Shoot me a DM on Instagram at Sterling the Investor. And I'll talk to y'all soon. Let's get this cheese.